For a long time, corporate success in the US was closely tied to growth narratives. Companies were celebrated for expanding rapidly, entering new markets, and delivering headline-grabbing results, even if earnings fluctuated wildly from quarter to quarter. Volatility was often framed as the cost of ambition. In 2026, that mindset has shifted. Across corporate America, predictable earnings have become a central obsession, reshaping how businesses plan, operate, and communicate with investors. This shift is not about fear of growth. It is about the rising cost of unpredictability. After years of economic shocks, interest rate volatility, supply chain disruptions, and changing consumer behavior, companies have learned that earnings volatility creates real strategic damage. Predictability has become a form of protection, credibility, and competitive advantage in an environment where uncertainty is constant. One of the biggest forces driving this obsession is investor behavior. Markets have grown far less tolerant of surprises. Even companies with strong long-term prospects are punished when earnings miss expectations or fluctuate sharply. Investors are placing greater value on consistency than on occasional outperformance. A business that delivers steady results quarter after quarter is often rewarded with higher valuations than one that swings between strong and weak performance. This has changed how corporate leaders think about guidance. Instead of issuing aggressive forecasts designed to excite markets, companies are becoming more conservative and precise. Earnings guidance is framed around achievable ranges rather than optimistic point targets. Executives are prioritizing credibility over enthusiasm, understanding that consistently meeting expectations builds more trust than periodically exceeding them. Predictable earnings also matter because of financing conditions. In a higher interest rate environment, volatility is expensive. Companies with unstable earnings face higher borrowing costs and tighter scrutiny from lenders. Predictable cash flows lower perceived risk, which directly improves access to capital and reduces financing costs. Stability on the income statement translates into flexibility on the balance sheet. Operational strategy has been redesigned to support this goal. Businesses are simplifying product lines, reducing operational complexity, and standardizing processes to eliminate unnecessary variability. Complexity often creates hidden earnings, risk through inefficiencies, delays, and errors. By streamlining operations, companies make results more repeatable and less sensitive to disruption. Revenue models have shifted as well. Predictable earnings are easier to achieve with predictable revenue. As a result, companies are emphasizing recurring revenue, long-term contracts, subscriptions, and service-based models. One-time sales and highly cyclical revenue streams are being balanced with steadier income sources that smooth performance over time. Customer strategy plays a critical role in earnings stability. Instead of focusing primarily on rapid customer acquisition, companies are investing more in retention and long-term relationships. Loyal customers generate more predictable revenue and are less sensitive to short-term economic changes. Predictable earnings are built on predictable customer behavior. Pricing discipline has tightened across industries. Aggressive discounting and promotional strategies can inflate short-term revenue but introduce volatility and margin instability. Companies are becoming more deliberate about pricing, aligning it closely with cost structures and long-term value. This reduces earnings swings and protects margins, even if it limits short-term volume growth. Cost structure has also been redesigned to reduce volatility. Fixed costs are scrutinized carefully and flexibility is prioritized. Companies want the ability to adjust expenses gradually rather than through sudden cuts. Variable cost models, outsourcing, and scalable infrastructure help align costs with revenue, smoothing earnings when demand changes. Technology investment reflects this same mindset. While AI, automation, and digital tools remain priorities, spending is increasingly justified by its ability to improve forecasting accuracy, operational reliability, and cost control. Technology is used to stabilize performance, not just to chase growth opportunities. Supply chain strategy has evolved to support earnings predictability. Instead of optimizing purely for lowest cost, companies are prioritizing reliability and consistency. Disruptions introduce earnings volatility through delays, emergency expenses, and lost sales. More resilient supply chains may cost slightly more, but they protect predictable performance, which is now seen as worth the trade-off. Boards of directors have made predictable earnings a strategic priority. Directors are asking management teams how strategies perform under stress and how earnings variability is being managed. Earnings quality is discussed alongside growth and market position. Boards understand that volatility undermines trust with investors, employees, and partners. Executive incentives have shifted accordingly. Compensation structures increasingly reward consistency, margin discipline, and cash flow stability rather than aggressive expansion alone. Leaders are encouraged to avoid decisions that boost short-term results at the expense of long-term predictability. Mergers and acquisitions are being evaluated through the same lens. Companies are favoring smaller, strategic deals that add stable cash flow rather than large, transformative acquisitions that introduce integration risk and earnings uncertainty. Predictable contribution matters more than ambitious synergy projections. Workforce strategy also supports this shift. Companies are aligning hiring with confirmed demand and focusing on productivity rather than headcount growth. Rapid hiring followed by layoffs creates disruption and earnings volatility. Stable teams enable consistent execution, which supports predictable results. Importantly, the obsession with predictable earnings does not mean innovation has stopped. Innovation still happens, but it is paced and controlled. New initiatives are tested in contained ways before being scaled. This limits downside risk and prevents large earnings swings if experiments fail. There is also a reputational dimension to predictable earnings. Companies that deliver steady results are viewed as well-managed and trustworthy. This reputation attracts long-term investors, partners, and talent. Predictability becomes part of the brand, signaling competence rather than complacency. Recent experience has reinforced why this matters. Businesses built on volatile growth models struggled when conditions changed. Those with predictable earnings weathered shocks more effectively, maintained control, and recovered faster. That contrast reshaped priorities across industries. In 2026, the new corporate obsession with predictable earnings reflects a broader maturation of U.S. business strategy. Companies are no longer assuming that volatility will be forgiven or rewarded. They are designing organizations to perform reliably across a wide range of conditions. Predictable earnings provide clarity in an uncertain environment. They support better planning, lower financing costs, stronger investor relationships, and calmer internal decision-making. While they may not generate dramatic headlines, they create durable value. This obsession is not about eliminating risk entirely. It is about choosing which risks are worth taking and which ones threaten stability. Earnings volatility is increasingly seen as an unnecessary risk, especially when it can be managed through disciplined design and execution. In today's business environment, predictability has become power. Companies that can deliver steady, reliable results gain trust, flexibility, and control. The new corporate obsession with predictable earnings is ultimately an obsession with resilience. And in an economy shaped by constant change, resilience has become one of the most valuable assets a business can build.